All right, here we go. So good evening. How are you? My name's Ricardo Menjivar. I'm the founder of Phoenix Trading Strategies. I'll give you a little history about myself. I used to be a commodities broker. I had a license Series 3 and a Series 34, so I was specialized in futures and in foreign exchange. I worked for one of the largest FCMs here in the U.S. Until 2011, and that's when I decided basically to break off and go on my own. I originally started trading, like many of you, many years ago. I started as a retail trader around 2002, and for about 5 years, I traded and could not make sense of it. I would win, I would lose, but I would not be consistent. So I decided 6 years into my trading career that I needed to basically make a change and figure out a way to break into the industry. So I went to work for a small introducing broker and got licensed, and then after that went to Chicago, where basically I worked with a team of engineers, and we were at the forefront in 2007, 2008, developing the first electronic communications network, where we actually created a bridge to bridge all top tier one, all the 12 top tier one banks in the world into one master feed for foreign exchange. So my experience is extensive. I've walked in your shoes, and I have gone to some degree a little bit beyond what many people would normally do, only because of the fact that, trading for me when I started to some degree was a passion, and I wanted to basically explore it and take it to the final stage. And that is what I'm going to show you today. This is basically a compilation of 12 years of experience in the market that I think you will enjoy, you might benefit from. If anything, it will open up your eyes to a new perspective that you didn't see before. So that's basically where I'm, where I come from, so you can have an idea that, I wasn't just a broker at one time. I was a trader just like you. But when I was a broker, I understood all the problems that traders had because I had come from that part of the world, that part of the spectrum. So me and my team, we started to develop algorithms back then, right after the 2008 crash of Wall Street, based on the subprime mortgage debacle, of course, that everyone saw. And a lot of protocols were changed. That is when the banks and market makers actually decided to begin their process of developing artificial intelligence in order to protect and manage their risk based on the incredible losses that they had due to the subprime mortgage debacle. So this is basically, I'm going to show you the whole story behind this so you can comprehend that everything is mathematically based. We are basically in a world of digital trading. There are no more trading desks. Those are gone. Let's be honest in that regard. The banks are now using algorithms, and they are using robots basically to trade. And they've done a very good job of creating, a level of artificial intelligence which can manage risk but cannot reason. And I'll show you why that is a disadvantage to them and why it is an advantage to you. So today I'm going to present to you our smart money trade analysis software so you can have an idea of why math is important, but more important is why everything has been encrypted in a way that they control the game, not you. Even though my algorithms can be applied in all three asset classes. You can trade futures, you can trade Forex, you can trade stocks. It doesn't matter because they apply the same principle. Minor adjustments based on the markets or based on time frames, really. It's not even, it's there. The changes are so minimal, it's not even funny. And I'll show you between both both markets because I trade both futures and foreign exchange. So we'll go over a few examples in that regard, but let's get started. I want to thank Mahesh and all of you for allowing me to present to you today, and I look forward to addressing any questions after the presentation. So let's begin. Let's go to the disclaimer. Future stocks and spot currency trading have large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in future stocks and Forex markets. Don't trade with money you can't afford to lose. This presentation is neither a solicitation nor an offer to buy, sell future stocks or Forex. The representation is being made that any account is likely to achieve profits or losses similar to those discussed on this presentation. Past performance of indicators or methodology are not necessarily indicative of future results. So let's continue. Fortune favors a prepared mind. There is a statement that all traders should live by. I live by it. Anything can be accomplished when mind is set to purpose. When we set our mind on something, basically we begin to explore many, many options. And the one thing that trading forces us to do is to be very dynamic with our thinking process, because we begin to look at many aspects of trading. We begin to look at indicators, we begin to look at strategies, we begin to look at fundamentals, at technical analysis. And so it brings a whole new world of information that many times we've never really been exposed to. So if you understand the rules of the game, then you can only succeed at the game, or at least minimize your risk and minimize your failures. And that's what this is about. That's what this whole presentation is based on. I'm going to basically show you that there's information that you've not really been disclosed, and that has not been disclosed to you. And the reason why is because most traders out there have not really been behind the scenes. So I'm going to explain to you what has happened behind the scenes from the banking perspective and make it understandable from a retail perspective, so that you can understand what their protocols are, what their rules of conduct are, and based on that you can come to your own conclusion as to whether the game is rigged or whether it's not rigged. I believe that it is rigged, but that's okay. I know the rules of the game well enough that I can actually see what is happening, and I hope that by the end of this presentation you will too. Understanding the market makers trade cryptography. They've basically encrypted their whole strategy. It's all mathematically based and digitally created. There is a lock on it, and make no mistake, we would all love to hack it, but you don't need to hack their encryption to discover that their trading strategies are based on basic principles of trading, and they haven't changed for the past 60 years. All they've done is recreated them. So what I'm going to show you is that there actually is a key of information in order to unlock their encryption, to understand their intent, their plan of action, their risk, their exposure, and why traders actually have a much better edge nowadays than they did before. Because technology can either give you an advantage or a disadvantage based on the information that you know. You either have access to the correct information or you don't. At the end of the day, though, I always tell people, if you can add 1 + 1, and if it equals 2, then I can teach you to trade, because everything is mathematically based. And everything that I'm going to show you, I can prove mathematically to you. And that is what this is about. It's about understanding that we can actually trade on factual information and not be guessing on a system or a signal that we're getting from somewhere and not have the full explanation or understanding of why that signal is being generated. I like to know why, and you're going to want to know why too, because at the end of the day, that is what reduces our risk and our exposure when we trade, whether you're trading futures, whether you're trading stocks, whether you're trading Forex. Why do most traders lose? First, they're using lagging indicators to make decisions, which usually lead to losses. Most of us, that did not really have good teachers in the past, were using moving averages, stochastic, MACD, RSI, Ichimoku cloud, many indicators out there that have been counter-programmed, Fibonacci, Elliott wave, Bollinger Bands, the list goes on and on. The market makers and banks invested back in 2008 over $1 billion in quants and the development of artificial intelligence in order to counter-program most of these indicators. So now they've become, to some degree, manipulated and lagging. And so when you use them, most of the time you get a late response or late signal. And sometimes you don't even know why the trade even goes against you, because everything indicates that it should go in one direction, then suddenly, it turns on you. Well, it's because they've manipulated the data in those algorithms, which are outdated now. So these are old mathematical outdated principles that can't really be applied in the present digital format that we currently trade. Second, you don't have the correct information to really assess risk when entering a trade. Everything is about risk. Every time you take a trade, you take risk on. At the end of the day, you're going to discover one thing, that you can be 95% accurate in the forecasting of your trade, but there's always a 5% X factor. And no one really controls that X factor because no one really knows when there can be a catastrophe in the market. However, you don't have to trade based on fear anymore, because if you understand the facts and the information, you'll be able to assess a 95% assurance in the trade that you get into. Many traders don't understand the decisions are being made systematically by robots and algorithms that have been created. Trading desks are gone. Most of the traders at the Chicago Mercantile Exchange are gone. They only have options traders there, and there's only 100. Where before there were 2,000 floor traders, now, if you're lucky, you'll see 100. Now everything else, now what they have is just servers all over the place. At the New York Board of Trade, Chicago Board of Trade, the CME, London Mercantile Exchange, everyone has gone digital. And so our industry was actually impacted by the development of artificial intelligence before anyone else. And this is something that many people don't realize and understand. So how do you outsmart a robot? Well, you determine what its risk parameters and decision protocols are with a better program. Phoenix Trading Strategies has done that for you. We'll teach you to beat their robots consistently when you trade, and you'll understand why. See, trading is like playing chess. Chess, when you're playing chess, a good chess player will usually outthink you 5-10 steps. So by the time that you move, or whenever you move a piece, and depending on how many pieces you've moved, he sort of figured out the path that you're going in. Well, the banks did that very well. They did many studies. One was based on fear, doubt, which is something that as humans, we basically cannot control sometimes. So they know when to trigger that in the market so that we don't get into a trade or get out of a trade. And that is something that sometimes will cause us to lose. Why? Because we don't understand in actuality what they're doing. But if you're in the same frame of mind, you can decode their next 5 moves and beat them at their own game. And that's what I'm going to show you. That trading is based off of 5 moves. It's like chess. So if you understand how to play chess, then you can win. You can beat them at their own game. How do we figure out this puzzle? Well, first, we must understand how their artificial intelligence is programmed and for what purpose. What is ISTP? Institutional Systematic Trading Protocol. ISTP is a protocol that they use to program their strategies into an encrypted algorithmic formula, which is now your opponent. This is what you're trading against. The question that is in everyone's mind is, what are those protocols? Well, we've defined them as 4. We've defined them as portfolio rebalancing based on mean reversion theory, high-frequency trading, which they do very well, and 4 components of volume: order flow, volume spread analysis, volume price analysis, and divergence. And last but not least, price action. They've been able to take these 4 components and actually create a formula where they actually confuse the retail trader. But I'm going to show you how to see right through the deception so that you can put all 4 pieces of this puzzle together and see the real trade behind the deception. That is what we're here for. What does our technology consist of? Well, our indicators run 4 different algorithms. We have a Forex radar, which basically identifies when out of a portfolio of 8 currencies, which are the British pound, the euro, the US dollar, the Japanese yen, the Swiss franc, the Australian dollar, the New Zealand dollar, the Japanese yen, the Swiss franc, identifies when 1 or 2 or 3 are out of balance in that portfolio and when they must be brought back into balance. I'm going to show you an indicator that we created that specifically shows you visually how that happens and how they use mean reversion to accomplish that. The power dot algorithm, this basically determines when they begin to do high frequency trading at specific price levels that they have pretty much defined as support and resistance levels. Now, when you see them, you're going to basically say, how can there be high frequency trading? You know, those candles look insignificant. It's like if there is no volume. Well, they do a lot of absorption trades. And so I'm going to show you how our volume indicator identifies whether a candle is truly bullish or bearish. And that's a concept that many traders can't really wrap their head around, because how can a bullish candle have bearish volume? Or how can a bearish candle have bullish volume? I will show you that they've kind of programmed this to basically hide this information from you so that you cannot see the deception behind the trade. The volume price identifier identifies discrepancy in order flow. It actually pinpoints the point of control in the candle where the buyers prefer to bid and the sellers prefer to offer. So you're going to see dashes in between these candles, and what these dashes represent is where the buyers prefer to buy and the sellers prefer to sell. When there is an imbalance, a discrepancy between those two, that is when we pay attention. And that is what this indicator does, because it does it very clearly. So when you combine it with all these 3 other algorithms visually, you actually are able to decode their intent. So Phoenix Trading Strategy is really, right now, I consider is the only software that gives traders all levels of a complete understanding of the market makers' protocols and rules of risk management and their trading strategies, and you'll see why. What is portfolio rebalancing? Well, first of all, we must understand that money is in constant motion, but there are parameters that it must maintain. The image on the right demonstrates one of our 4 algorithms that demonstrates what I call currency portfolio rebalancing and why. Basically, you can see each line is represented by a currency. So this one, being the British pound, shows that it's out of balance. Why? Because it's been strengthened against a portfolio of 8. This one at the bottom represents the New Zealand dollar, and it shows that it's been weakened against a portfolio of 8. So we look for these anomalies. When we find these anomalies, yes, I did send the link. Oh, did he join? I'm sorry.
No, that's the second gentleman.
Oh, okay. So, forgive me. So what this indicator shows you is how they take currencies out of balance and then bring them back into balance. Some of these are in balance. So when they're in balance, those currencies don't really move. They can't. Why? Because they need to bring the currencies that they've taken out of balance back into balance before they take others out of balance. So it's a rubber band effect. So what happens is this: if you extend a rubber band between both hands, you can only sustain it for so long. Eventually, it has to come back into, into balance, or it'll break and it will cause a whipping effect in your hand, which is very painful. Well, the same concept applies to them, and it applies to us. Understanding this principle will allow you to realize that sometimes you don't have to be trapped by just trading certain pairs. You'd be surprised at how many times they may not use the major pairs to rebalance their risk. They'll use other exotic pairs, outlying pairs, a pound yen, a pound New Zealand, a euro yen, a euro New Zealand, a CAD Swiss. These are pairs that normally you would not trade. And so why? Because you're not accustomed to them. You're accustomed to trading the 8 majors because that's what we've all been taught, and that's fine. Sometimes trading the 7 major pairs does work, and there are great trades there, but that isn't always the case. So when you look at it from that perspective, you'll see that this algorithm can only guide you by telling you if there are two currencies that are out of balance, and if they are out of balance, then maybe you should be concentrating on that pair because that's the one that's going to move. And I'm going to show you that very shortly. So these are examples of trades that I took this week. I believe this one was last week. This was on the Dow futures. Now, what I'm going to show you here, I'm going to explain to you what the algorithms are, and I'm going to explain to you why I have 3 moving averages. Their whole theory of risk runs around one principle, mean reversion. They use 3 moving averages in their formula. They use this white one, which is a 200, a 100, and a 50. This is basically how their algorithms are trading and what they're using to define a lot of their risk parameters. The power dots, what this basically announces is that there is volume, momentum, and liquidity buildup coming into the market, which equals trade opportunity. Now, this line that you see here that I drew here at the bottom, this line basically shows and explains that in a higher time frame, a 120-minute, there were power dots at this level. So when price came down, and I had already missed this trade because this happened during the European session. I rarely trade. I only trade the European session Thursday mornings from 2 a.m. to 4 a.m. because I live in California, and so that is midnight, and I love my sleep. I consider it sacred, and you should too. So I trade the U.S. session. I'll trade the Asian session, and once in a blue moon, I'll trade the European session. But what I want to show you is that here, for instance, I've defined where my entry was. This was my entry. But this is the candle pattern that led me to the trade. Why? Because we have volume divergence. So how is volume divergence defined? Let me bring a bigger picture of that so that you can see. Volume divergence is defined based on how their orders are coming in. So my volume indicator basically is an algorithm that separates their buying and selling volume as it's coming in. So it tells you if this candle is truly bearish or if it's bullish. Well, in this case, this one that was a bullish candle is bullish, but at one time it was bearish. Why? Because it came down and it settled bullish. So even though it's green, at one point it did come down, hit this level, and that's why it was red, and then it went long and settled bullish. I'll show you later. In a later example, I'll pull up a chart and I will show you how the volume indicator actually does that. This is where I would have preferred going in, but I was late. It's okay. Why is this candle pattern significant? And why is this information that I'm going to share with you significant? You see these dashes? This is the volume price identifier. This actually decodes their point of control in the candle. When we think of candlesticks, we all think of the open, high, low, and close. That is what we look at. We cannot fathom the thought that there is a specific price level where the buyers prefer to buy and the sellers prefer to sell, because it's information that's never really been disclosed before. So when we created this algorithm, it was to basically decode how order flow was basically manipulated by the market makers and the banks, and how their algorithms were hiding this information from you. That's why I said technology is a double-edged sword. It can be in your favor or it can be against you. It's all that matters is, do you have the information to actually make a decision to assess risk? Well, in this case I did. Why? Because this bar, even though it's negative, showed one thing. Number one, that it did come down all the way because it was bearish, and number two, that it settled with bullish volume. See, this line basically is a 50% line, and anything that settles above it is bullish. Anything that settles below it is bearish. So when I see a bearish candle settle with bullish volume and the body of the candle, price action, actually closes at a slight distance from the point of control, the way this one did, I get excited. Why? Because I look to see if there was volume divergence, and in this case there was. They threw everything, including the kitchen sink, at this candle. This is a high frequency candle. The amount of volume that they threw in here was so big that that's why this bar exploded. But it didn't settle all the way down here, it settled here. And then this candle came in and then settled bullish. But more importantly is that this candle didn't make a difference for me. This one did. Because this is the one that determined, number one, that they were going to change directions. And if you can isolate when they're going to change directions based on the discrepancy between the point of control, price action, and volume, then you have just basically decoded their whole trade. And from now on, you can only win. Because all you need to look for is this trade. You don't need to look for anything else, and I'll show you later why. My entry was not here, and it wasn't here, even though this one closed bullish. I actually waited because I wanted to see what this candle did. So when I saw that this candle actually closed above the point of control, and that it was bullish, and that it had bullish volume, then I assumed that the next one was going to be bullish as well. And that's exactly what this did. It popped. And when it popped, it came up. I got out with, I think it was about 41 ticks, based on my entry, which was 17,590. I exited at 17,631. So that's exactly what this trade signified. The next trade, the next example, is on gold. And this one was actually taken this week. And I took this one, actually, it was late in the evening for me. I'd like to say it was close to 6:30, 7:30 my time, Pacific time, which is about 6:30 a.m. your time. Now I'm going to show you this trade, in a much bigger, let's see, here it is. So this is basically, again, we're looking for the same pattern. I love this pattern. I kill for this pattern. More importantly, because they did it right around the moving averages, which they're using as a mean. So what does mean reversion mean? So, it's very important. Whenever they trade away from these moving averages, they trade right back to them. And sometimes they will maintain themselves around them or move away from them. Well, when they move away from them, if this market is actually range bound, then it will come right back into balance. So this candle actually depicts it, but more importantly is that volume divergence began here in this candle. So this candle is very bullish, but then this one started to diminish or decrease in volume activity. And then this one did exactly what I wanted it to do. It went up, it was bullish at one point, and then it became bearish, and it settled right below the points of control. More importantly is that the volume bar was negative. It was bearish. So I waited. They hit it again, came up, tested it, didn't do much. And then finally this one came in, and this is where I entered right here, a short trade. Now this trade, you can go back to the date on this, 5/22 this month. And I got in here at 1256.10. It was a $3 move. $300, but it actually moved $9. So, or close to, oh no, $10 actually. I could have made $1,000 on this one contract. But I woke up, or no, I was still awake actually, and it was right before I went to bed. And this was close to 11 p.m. my time, which would be 10 a.m. your time. So I got into this trade here at 6:45 my time, and I got out at almost 11 p.m. You know, you could say, well, that's a long time to stay in the trade. Well, I could have picked up $2 here, but I knew they were going to come down. And I knew that they were going to come down when they broke right through the 200 moving average. And if they didn't come back and retest and trade actually above this candle, then I knew they were going to come down. And when I saw that they came down, then I knew it was over for them, and it was just a matter of time before they broke through. So for me, a $3 move is very significant, but more importantly is that I was able to detect and determine that there was volume divergence to the downside, and you will usually identify it 2 to 3 candles before they hit this discrepancy. This is an anomaly of the worst kind. It's an imbalance of imbalances. They cannot hide this from you anymore, at least not with our software. The next trade. Let's go down. The Russell. This one is very interesting, and this one I did this week as well, actually. This one was done at 7 a.m. my time, which is 6 p.m. your time. Now I want you to look at something. This is where I tell you that their deception is so incredible that it goes above and beyond your sight of your mind of sight. I mean, it's incredible. You know, these power dots basically announced one thing: volume, liquidity, momentum, which equals trade opportunity. They did it here and they did it here, but they used the trend stop, which is an ATR level, to actually hold the trade before coming down. Now, more importantly, is that you can see there was hardly any volume here, but here they threw everything at it, and this is where it began. So this is 6:30, around 6:30 a.m. my time, which is when the U.S. exchanges actually open in the cash market. So in the futures, it gets very active. But more importantly is that this candle had bearish volume. It settled bearish. So there was negative volume in this candle. That was one. Number two is that the next candle, which my entry was based on, at one point did come up, but and then came right back down. But more importantly is that it settled right below, it closed right below this far away from the 2 points of control. And number two, it was negative. So now I had two candles basically demonstrating that there is volume divergence to the downside, and they were not going up. Now, if you see a trade like this to the upside, then you begin to believe, when you see a candle like this, that they're going to continue to go up. This is where the deception takes place. And if you don't have the correct information, what happens is that you lose. It's called checkmate, gentlemen. So what I do is that I show you how to see that checkmate that they want to put you in. When they put you on check, then you turn it around on them and you put them on checkmate. And that makes the ability for you to now trade on your terms, not theirs. This information is so that we can assess risk, determine the deception behind the trade, and trade on our terms, not theirs. When you begin to see this and understand what their trade plan is based on, then at that point, you can finally start to look for the correct information and for the right trade. And that is what these trades are based on. So I'm showing you that that volume divergence does exist, number one, that a bullish candle not necessarily will have bullish volume. It may settle with negative volume. And based on that, if you see that there is a consistent volume divergence in the volume bars, then this will go down. Now, I haven't showed you how to read the numbers here, and I will show you very shortly. So this one, it was 42 ticks. and I got in at 11:42, got out at 11:37.10. So it was a 42 tick move. I got in at, it was about 6:50, and I got out at 9 a.m. So almost a 2-hour trade. Nothing, most of the trades that I take usually will be, a half hour to 2 hours. I'm in and I'm out. Why? Because my risk is minimal. I'm a speculator, just like you. We speculate when we go into the market. Now, can you have a trade that runs for 4, 8 hours, 2 days? Of course you can. I show examples based on small time frames. Why? Because if you on higher time frames, you can identify the same pattern, but you'll always go down to the smaller time frames to determine better entries. That's just the rule of the game. So let's go to the next one. EURUSD. This one I took at around midnight. It was around 12:30 my time, which would be 11:30 p.m. your time. And I'll show you this one in the higher time frame here. So my entry was here. Why? I had volume divergence here, and this candle right here, even though it was trading with, they were using the moving averages as a mean to trade away from them, they did one thing. This candle, even though it was bearish, number one, settled above the point of control, which is bullish. That's one. And number two, it settled with bullish volume. Now the gray bars in the volume basically tell you that this candle is trading inside the previous one. When they go magenta, it tells you that it's trading outside the previous bar. And then you have red and turquoise, which are basically your bearish and your bullish trades. So this one had the signature candle pattern with the anomaly that I look for. The anomaly, this one here, this one had the anomaly with the volume. The discrepancy between price action and the point of control, my entry was the next one. Came down, never broke below the 200 moving average, and then basically it just went. I got in here, it came down here. My risk is never more than 10 pips. That is how tight my stop is. 10, 12 pips max, and I stick to those rules religiously. When they play the trade, they went long. I left it, went to bed, woke up, 6:30, I was up 41 pips. Now, one thing that I do once I enter a trade after an hour or so, I will go to the 60-minute and see if on the 60, the 30, or the 45, they have set up a similar pattern in the higher time frame with volume divergence, basically announcing that they are going to continue that trade. And if I see and confirm that, then I know that I can let that trade basically run and develop because it's going to play out, and there's nothing that they're going to do because the decision has already been made. Even if there are news that are coming out in the morning, they don't care. The algorithms have already been programmed to trade away from the mean and basically move the market, and that's what they do. Last trade, this one I took yesterday morning, and this was after a webinar that I did for some of my clients. On Mondays and Fridays I hold a free webinar room, and this was after we finished. Now, couldn't really find a trade beforehand, and I'll explain why. It was just too choppy. I didn't get the trade that I was looking for on my terms. And so if it's not on my terms, I don't trade. Well, finally, I found one on my terms. This, you can see here, the point of control shows an imbalance. So I'm going to show you what it looks like from a magnified version. Number one, when I saw this, I said, this is a bearish candle, but the point of control, the buyers are announcing that they are not going to buy below this level. And the sellers wish to sell below this level, but there is an imbalance. There is, order flow is basically telling me something different. It's not correct. And so when I saw this, then I looked and I saw that there was volume divergence here. It began here. Then how can price action be going down and volume divergence be going this way? These two concepts cannot coexist. You cannot have price action going one way and volume divergence going the other way, because eventually they're going to flip on you. So what happened with this trade? Very simple. I saw this. I saw that there was volume divergence. I saw that this candle had settled with bullish volume. And so when it settled with bullish volume, it caught my eye. And I said, okay, I'm going to pay attention to this. Then I saw the next candle. The next candle came in. It had slightly bearish volume, but it didn't go down much further. It held. So I got in right here. A 30 pip trade is what this basically developed. But I saw that there was volume divergence literally 4 candles before my entry, and they basically gave me the pattern they were looking for, and they had already traded away from the mean, which were the 3 moving averages that they religiously use in their algorithms. So this basically allowed me to say, okay, this is a true mean reversion trade, and it's going to come right back. So when it came back, I knew that they were eventually going to come back to the 200 moving average, which is very simple, not a big deal. Janet Yellen spoke, and like I said, sometimes it doesn't matter who's speaking. They already know what, in many instances, what the numbers are going to be or what is going to be said, and so they're just going to follow their program and their trade, and that is what we do. So this is really important because it defines a strategy that and information that you didn't have before. When you look at candlesticks, again, you're looking at the open, high, low, and close. Well, that doesn't mean anything anymore, because if you don't understand what they're doing internally within that candle, you can't decipher their code. You can't decipher their intent. You can't decipher their trade because you don't understand the rules of conduct. Again, this is a chess game. They know that you can't see this, and because you can't see this, because you can't see this, they come to the realization that if this trade is going short and it's already broken below previous lows, then your assumption is that this is going to continue to go short. You would never think that they were actually going to, hold this level and then come right back. So this is the type of information that gives you an edge because now you have a complete picture of what you didn't have before. Let's go to the next one. So our smart money trade analysis software provides the solution. By using our smart money trade analysis software, you're getting cutting-edge technology that works and decodes the banks and market maker strategies. You can now look at the trade without any fear and doubt because you have all the information to make a confident decision. We remove fear and doubt from your decision process. You can face your artificial intelligence with your own confidence and trade on your terms, not theirs. And that's what this is about, is really trading on your terms, not theirs. When we do that, that makes a big difference because, I like to trade on factual information. I like to know what's happening. I want to know that it makes mathematical sense. If it doesn't make sense to me, I can't jump into a trade because I'm taking risk on. It just doesn't, make sense to me. So this indicator, as you can see, where did I base my decision to trade the euro and the euro Aussie? Based on the fact that the Aussie was getting strong and the euro was weakening, this is where I based my decision. Now, by the time it happened here in the 30-minute, I was already in, so I looked at smaller time frames. So what I do is that I teach people to look at this on lower and higher time frames so that they can get a better assessment of what is in balance and what is out of balance. And when you can see what they've taken out of balance versus what they have in balance, you're not wasting your time on currency pairs that just don't matter because they're not going to move. So this indicator is not meant to give you an entry. It's meant to wake you up and tell you, hey, maybe you need to pay attention to what's happening. So then the next step is we created a market analyzer. And the market analyzer, what this does is basically, instead of you having to look at every pair or every instrument, what it does, it tells you when there are power dots that are formed. You can look at it on a 10-minute time frame, a 60-minute time frame, a 180-minute, a 240-minute, a 720, a 12-hour time frame. It doesn't matter. You know, it depends on your trading. You know, on your trading strategy or plan. If you are a long-term trader, then you're going to look at this in higher time frames. If you're a short-term trader or an intraday trader, the way I do, then basically you're going to put it on smaller time frames, and you're going to pay attention when this lights up. Because when this lights up, it basically tells you, go take a look at the market, which is exactly what I do. So let me move this, and let me bring up the chart, actually. So this is that same trade that we talked about. Where was this? No, this is the pound New Zealand. I want the Euro Aussie. Euro Aussie. Give me a second. And I'm going to show you how the volume indicator actually clarifies the discrepancy between, you know, the buying and selling that's taking place in that candle. Give me a minute for this to come up. Okay, so this is where my entry was. This was the candle, but on this 10-minute, there was a power dot level here. So this basically identified a price level that they were going to use to rebalance. So what I do is that I teach you how to map this out so that you can pinpoint their support and resistance levels that they're using for the day. And when you do that, then it makes everything much easier because you pay more attention to when they reach a specific level. See, this trade took place at 3:30 in the morning, my time, which is about 2:30 in the afternoon, your time. Now I'm sound asleep. As much as I would have loved to take this trade because there was volume divergence, this candle right here had negative volume. It settled with negative volume. But it wasn't my entry. It wasn't the trigger, but it said pay attention. There was a power dot here, so more reason for me to pay attention. This next candle settled with negative volume because it was bearish, and it traded inside the previous one. And then this one is the one that basically would have given it away. Why? Because price action in the candle closed below the point of control. It was bullish at one point and settled with negative volume. That basically said they are going to trade right back to the mean and go right through it. This trade was a 26 pip trade. This trade that I took, I got out with 30 pips, but it was a total of a 33 pip move. So again, my stop loss is no more than 10 pips. But when I exit, I will usually exit literally, you know, if I let the trade develop 10 pips below or 5 pips below its maximum range. And that's not bad. So that allows me to because I understand what they're doing and I understand how their strategy is based on, which is mean reversion, and the means that they're using, which are 3 moving averages, the 200, the 100, and the 50. Now, just because you use these 3 moving averages doesn't mean that you're going to get these trades without having this information, because if you cannot see when there's an imbalance between the points of control of order flow between the buyers and sellers, you're guessing. I don't like to guess. I like to be sure that when I get into a trade, I know exactly what I'm expecting. I know exactly what my risk is. If it goes against me, you know, I may lose 5, 10 pips. I'm okay with that. You know, maybe I didn't have all the information, but in this case, I had all the information. You see, this concept of price action going down and volume divergence going up cannot coexist. This is the one thing that you have to come to terms with. This is a complete lie. It's deception. And when they broke below the previous lows and they were trading here, if you didn't have this information, you would have said, this is going to continue to go lower. It's going to go down another leg. And then they would have caught you with your hands down, put you in a checkmate position, and taken your money. Where here, they basically announced check. I turn it around and teach you to put them on checkmate. And that puts you in control, which gives you the terms that you're looking for to trade. When you're in control, you trade under your terms, not theirs. That's the difference. Now, if we look at the volume, as you can see here, the data box shows you what the volume was here. This is a bearish candle, but it had a bullish volume. Now, you can say, Ricardo, we can't really see the volume in Forex. You're right. I've synthetically created it to show you that you can. This candle had 148 million on the buy, 127 million on the sell. No, this one, forgive me, it had 148 million on the buy, 127 million on the sell, a difference of 21 million net bullish volume. Okay, so this is a bearish candle with bullish volume. Now I know that this concept is just so hard for you to visually comprehend and understand that it can exist, that now you can actually look at the banks and market makers as complete and utter liars and thieves. They're unethical from every level because they have manipulated information and they have misled you to believe that we are trading on a fair playing field when in actuality we are not. But if you understand the rules of the game, their rules of conduct, their protocols, their decision process, and you can see how they basically, with the correct information, you can actually decode what their real intent is, then you don't become a victim to the trade. You look forward to the trade, and so you don't enter a trade with fear and doubt in your mind. You enter it with complete confidence because you know you're going to win. See, this candle, even though it had negative volume, it didn't go down. You know, it held right above this power dot level. But we knew that they were going to do high-frequency trading here because this is where they like to do high-frequency trading. It was announced earlier in the day. So this one had 108 million on the buy, 130 million on the sell, difference of 21 million. Why didn't it break through this level? If this is already bearish, I want to see this thing rip through this price level, which is a support level that they're using. They chose not to. So then this candle comes in, you know, with 131 million on the buy, 129 million on the sell, difference of 2.9 million. And it settled bullish. And basically, because it didn't go down, and my entry was here, it sort of led me to believe we're going long. The next candle had slightly bullish volume, but what was the discrepancy? It closed higher. So I didn't care that it had a little bit of bearish volume in it because it settled higher. Because I knew that this and this was what they were not wanting me to really understand and see. And so when I teach you how to read this, then all the math comes into play. And that's why I say, if you can learn, if you know how to add 1 plus 1, 2 plus 2, this is easy. This is not difficult, gentlemen. This is, you're going to be in control of the trade that they don't want you to be in. And instead of you taking these trades, which are, I consider, highly risky because you never know when they're going to shift, you're going to see information from a different perspective, which will allow you to actually be in control of risk. Again, we take risk on when we trade. So I teach you to understand that these concepts, you know, cannot coexist. You cannot have volume divergence and price action going down. It just, you know, it just cannot be. You know, there's something wrong logically. It doesn't make sense. So I show you what makes sense and what you should look for by isolating the price levels that are their true support and resistance levels on an intraday level, by showing you when they have taken a currency out of balance, which in this case, this indicator basically leads you to, but doesn't really tell you take the trade. No, you go in there, you do a little bit more analysis, and you see if there are power dot levels, if this is a true support or resistance level. You know, if I was awake at 4 a.m. in the morning, I would have paid attention to this, but I wasn't. I was asleep. So would I have taken this trade based on this candle pattern? Not really. It had negative volume. They did have power dots. You know, this one was the one. Why? Because this one was bullish, settled with bearish volume. This one was bearish, settled with bullish volume, and then they did it right at a price level that they knew they were going to basically stop. And since they had already traded away from the mean, which was these 3 moving averages in their algorithm, then basically I knew they were going to come back. See, they're using basic, simple concepts in their algorithms. You know, and I was telling Mahesh that one of the reasons how I discovered this is that I was studying the Case-Shiller index, and Shiller actually wrote a thesis on mean reversion, but they hit it very well. Here you have to really do your research to find those, those papers to read them. And so I went and I started looking at other PhDs that wrote on mean reversion as well, and very complex papers that these guys write. You know, they're mathematicians, they're economists, and so they write in terms and levels that most people just cannot comprehend, and they don't. And their visuals are horrible. They, their way of giving a visual explanation is just, you cannot understand it well. But since I understood what they were talking about, and I had the technology, all I needed was a few little tips that they needed to provide me, and that is how we ended up developing this strategy, which is now 95% accurate when you trade. So, being that said and done, what do you do now? Well, we want you to think big, take action, manifest your greatness as a trader. Now you have all the information. You will no longer define yourself by your failure, but by the impact that you will have in your life and others, because your decisions are based on mathematical facts, not assumptions. You know, when you assume, you cannot be 100% right because you're assuming. I like to be right. And if I'm not right, and if I don't have all the information, I can't trade. So this is pretty much your moment where you come out of the darkness and into the light, because now you can trade on your terms, not theirs. So what I do is I offer a 4-day training course with the software, and I literally can tell you that you will master it in 30 days. Not years, in 30 days. Because I will train you to look for specific information that their algorithms so kindly display with our software. Because when we call it smart money trade analysis software, it's because we are following the smart money. The smart money is the banks and the market makers. That's the money. So, any questions?
Anybody? Questions?
So it's basically coming to joining the trading calls, right?
Well, he trades live. I've seen him for over a year. I mean, he's a good friend of mine also.
I see.
But you see, the software is developed as something proprietary.
Okay, but then he isn't giving you the software as such. He has given you the methodology of doing it.
Yeah, but then once you have the software, that's because without the software you can't. I have a software installed on my laptop as well.
Right, right.
So till you don't have it, because you cannot, normal MetaTrader, as all of you all know, you can't see all this information. You don't even have half this information. You know the high frequency levels which he marks as power dots, the ATR stops, and again, the volume is of a much more better quality than what you get on a normal MetaTrader 4, which is what is needed to see the volume divergence, plus the proprietary, the point of control of the candle. Now he's showing you that the candle is bullish, but bearish, but the volume is bullish. You can't see all these things in these free platforms. So naturally, if you're going to compete with, because as I said, he himself said he's got 20 years experience in the industry, so he knows what the back-end algorithms are doing.
Basic is that you take the software.
And the course, of course, he runs a live trading room twice a week. I've been taking it for a year, otherwise I wouldn't bring it to the group.
Right, right. But then this particular course software buying system?
Then why don't you directly? He will post his email or Skype or WhatsApp you like.
What is the cost of course?
The software,
Why don't you do it?
yeah. The software,
Ricardo,
yes, go ahead.
why don't you post your email and let everybody individually email you your
Okay,
Skype?
yeah.
Yeah.
My email, these are my
You
emails.
can detail and talk to him.
Yeah.
Yeah, that's his email, and his YouTube link is also there, and his telephone number is there. And if you have any doubts or other, you do not understand, the clarity is not there, you can, like, what he shared with me some time back was,
YouTube is better than one can go through the YouTube.
yeah, you can go through the YouTube channel and
How is the YouTube?
Oh, yeah.
You have to write all this address?
You can go to the YouTube channel. Let me show you where. When you go to the YouTube channel,
You go back
put
to
in Phoenix
YouTube
Trading
address.
Strategies. You hit, just hit the link, and you can. These 4 videos or 5 videos actually explain everything, and you actually get to see live trades that I do in the trading room Mondays.
But what is it?
it's posted in the group. Someone, you can share it with your friend on the WhatsApp. Somebody has posted a picture.
You posted
Yeah.
already?
Somebody
Somebody
has posted. Yeah, somebody has posted.
Okay.
So
you can please add arrange his number also in WhatsApp.
yeah, you tell Javon or somebody.
I don't have any info. I'm coming for the first time.
No, that's okay. Go through the YouTube,
It's a WhatsApp group, you know.
so you can have all the
It's done,
information.
right? You got it.
Okay, it's already shared.
Okay.
And yeah, so any particular questions, technical questions?
The volume that he is talking about,
Yeah.
is the volume of that particular broker he goes, or if it is global volume?
Ricardo,
Yes, what was the question?
can you hear? Can you hear us?
Yes, I can hear you. Go ahead.
Yeah. Somebody, can you?
Yeah, the volume that you are saying, is it the volume of that particular broker, or is it the global volume?
Can you repeat for him, Mahesh, because I couldn't understand him.
The
Trade volume.
Yeah, the trade volume, is it from a particular broker or is it a global volume? That's the gentleman's question.
Oh, okay. The volume. Okay. The volume that we use is basically a data feed from a NinjaTrader called Kinetic, and Kinetic has 13 liquidity providers. It has all 12 top tier 1 banks and 1 additional bank. We really don't need more than that, because with the top 12 tier 1 banks, we're able to get all the volume in the market. Because remember, the market is not really manipulated by the retail trader. It's really controlled by the institutional money. So you see, between you, I'm going to explain to you how this works. So between you, there is the broker. Between your orders and the broker, there is a liquidity provider. Well, that liquidity provider takes on retail trades. You're not trading against the banks. The banks don't take trades less than $1 million, a trade. So if you don't have millions of dollars, you're not trading directly with the banks. There will always be a liquidity provider in between you, the broker, and the banks, which I prefer it that way because it makes it, someone has to lose. This is a zero-sum game, gentlemen. The banks don't necessarily have to know what you're doing, because if they did, they would scramble. But see, they're not going to change their protocols or their rules of conduct, over a small percentage of traders that have this information. Now, they would change it if a few hedge funds or a number of hedge funds had this and they were basically ripping them limb from limb, then that's a whole other game. But they still can't hide the information. So on MetaTrader 4, I used to sell people to trade on MetaTrader 4 as a broker. I love MetaTrader 4 only to enter my trades because it's very easy to manage them. But MetaTrader 4 has basically limitations. You can only see a 1 minute, a 5, a 15, a 30, a 60, a 4 hour, a daily, weekly, and monthly, where professional traders, and the way that you should be looking at the market and use the tools that you should be using, should allow you to look at a 7 minute, a 10 minute, a 45 minute, a 120 minute, a 2 hour, a 480 minute, a 720, a 1440, a 600 minute. You know, I look at, these are the time frames that I look at, and the one thing that I like about this strategy is I have time. I am not in a hurry to get into a trade. Before I get into a trade, I usually have minimum of 30 minutes, a half-hour window. That's a lifetime of information, gentlemen. Lifetime. If you have a half-hour window notice before the trade actually takes place, you're in control. You know, my entry was here, but look how many candles it took for them to actually kick the trade and execute. 1, 2, 3, 4. That's 40 minutes after I entered. So this allows me, these 30, 40 minutes, once I'm in the trade, allows me to go back, look at higher time frames, and really, map this out. So I look at a 1440, I look at a 720, I look at a 600, I look at a 480, a 300, a 240, a 180, a 120, a 90, 60, 45, 30, 20, 15, 12, 10, 7 minute, and even a 5. I don't go below the 5 because I don't need to. This pattern, this discrepancy, this imbalance between volume, order flow, and price action is not really captured in the small time frames. The 3, the 1, the 4 minute, the 2 minute. No. This is done in the 10, from the 7 minute to the 15 minute. Now every pair or every instrument is different. You know, when you're trading futures, you're going to look at a 7 minute, where in Forex, you just need to look at a 10 minute. Here in futures, you'll look at a 12 minute, where in Forex, you might just need to look at a 15 minute. And so every instrument is different. So what I show you is to basically isolate the time frames that each individual instrument and market has and how they are basically displaying this imbalance between the candles, price action, the point of control, which is the order flow, the volume. When you see all this and you isolate it, then you know that that's what you need to look at. And more importantly is that this other indicator right here, basically you can look at it on a higher time frames. I never, ever look at it below a 10 minute, ever. It just doesn't make sense, because I want to see an overall picture of an imbalance where they have actually strengthened a currency against the rest, and where they have weakened another currency. So I'm looking for this type of imbalance. I'm looking, my whole game was the Aussie dollar. I looked at it because I didn't find much trading, on Friday. We caught a crude trade long that went up 45 ticks, and I got out with 15 ticks. And I got out because it came right back to my entry. I said, nah, I don't. It was coming back to my entry. I said, no. I like to take what's on the table. When there's a lot of momentum in the market and liquidity, if it doesn't go my way, the way I want it to, then I take what's on the table, and then basically I come back and reassess, or I'll go look for something else. But I will tell you one thing. This system will allow you to isolate 4 to 5 different trades each session. So that's 4 to 5 trading opportunities each session. Now, I can't ask you to trade during the Asian session because you're sound asleep. And I consider sleep to be very sacred. I say, Mahesh understands this very well, because very few times he woke me up in the middle of the night, and I told him, Mahesh, it's the middle of the night. But he, at the time, I was showing him how this worked, and so I had to make some time for him, so I will make exceptions one time. But, if you have any questions, I'm usually available on Skype, and you can usually Skype me, and if I'm in front of my computer, I'll take a look at a trade for you, and I'll confirm it. Why? Because at the beginning, you need that guidance. And I understand that. That's why I open the room Mondays and Fridays, so that you can actually see me take these trades live. Because one thing is for me to talk about it, another one thing is for you to actually see it. That's why the videos, the YouTube channel are very helpful, because they allow you to see what we do on the live edge of the market. You see, I don't need to look at historical data and go back years. That, my system is not based on that. I do look at retrograde analysis. Why? Because you see these magenta dots here, these are pivots. So whenever a trade goes, for instance here, I saw that there was, let me see, there had to be a pivot here at the bottom, a few pivots here that would have, no, they weren't there. For instance, here, when this trade broke right back up, as soon as it broke this pivot, I knew the next one was here. And I knew the next one was here. I got out here. I didn't care that it come up any higher. If I'm in a trade and I've already skinned them for 30 pips, and I see that there is volume divergence coming in because this candle, as bullish as it looks, has negative volume, and let us see why. Then, look at this. It had, hold on, let me bring this down. This candle had 348 million on the buy, 360 million on the sell, a difference of 12 million negative volume. It's a bullish candle with negative volume. I'm paying attention to that. Why? Because there's something wrong with that statement that they're making. That means that the trade is ending to the upside, and they're going to start to decrease their order flow to the upside, and they're going to start to show more negative volume to the downside on these candles. So this one, as bearish as it really wasn't. It was pretty bullish, if you ask me. 318 million on the buy, 324 on the sell. The difference was 4.9 million. And it did it right at the moving average. So I got out here. I didn't wait for it to come up here, and I just didn't need to, because I saw it was coming down. I said, nope, I'll take what's on the table, 30 pips for 30 pips. If you find 2 trades in the morning during the U.S. session, and you make between 30 and 50 pips, you made your day. If you find 2 trades or 3 trades during the European session, you've made your day. If you find 2 to 3 trades during the Asian session, you've lost sleep, but you made your day. I love my sleep, gentlemen. That's why I say I only trade on Wednesday nights, which is Thursday morning Eastern or Wednesday nights for you would be 10 a.m. your time to 12 noon. That is when I usually trade the European session, and only because I have, clients that are in the Middle East, in Europe, in Australia, in parts of Asia, in some parts of Africa, and so, or in some are in South America, and they want to trade the European session. So I came to the conclusion that I had to trade one day the European session to actually just call out trades, and that's what we do. We look for trades that one day of the week, and we look to make money. Mondays and Fridays, I showcase the technology, the indicators for new people that want to come in, but I still look for live trades. We always are looking for live trades. That is just, our I guess, statement is that, we're looking to make money all the time. If we can't find a trade, you'll see videos where, I may take 30, 40 minutes into the session, and we may not find anything. And then suddenly we find that golden trade with all the terms that we look for, where they try and put us on checkmate, but it's actual check. We reverse it, put them on checkmate, and then we win. So we trade on our terms, and that is what I want you to really wrap your head around, that you cannot trade on your terms if you're using a free platform like MT4. Go ahead. I missed that. Mahesh? Hello?
Yeah, anybody? Any question? Yeah, Ricardo, you hear me?
Yes.
Yeah, okay. One second, please.
Sure.
Simon? Come on. Anything?
Thank you.
Anybody else? No? Okay, Ricardo, we wind up here. Send me a link of the recording.
I will do. I'll convert the recording and I'll send it to you. If you have any questions, like I said, send me an email. These are my emails. And if you want to sign up for the room, what I'll do is that I will send Mahesh the link to the webinar room for Mondays and Fridays so that you can sign up. And I hope to see you there. And if you have any questions, if you're interested in software, let me know. I'm always here. Thank you very much. Thank you so much for having me.
Okay. Thanks a lot, Ricardo.
Have a great one. Bye-bye now.